Colleagues, greetings to you in this joyous season. I want to share some important information about how the pension boards determines the amount of your monthly annuity payments year over year. Immediately following this brief overview, we invite you to stay tuned to watch an informative fireside chat where the Reverend Dr. Jim Mose, Executive Director of the Pension Board's Faith and Finance Ministries, and I will discuss the yearly annuity change process in detail. But before we move to this fireside chat, I want to discuss the Board of Trustees' decision for your 2021 annuity payment and the reasons behind it. At their recent meetings, the Benefits and Investment Committees recommended to the full Board of Trustees that monthly payments from the basic and participating annuities would remain unchanged for 2021, and here's why. Although financial markets have been strong, interest rates have dropped substantially, which led to lower but still healthy funded status in our annuities. This decline in interest rates was taken into account by the committee and the board in their decision. We recognize that there may be concerns about why a decision for an annuity increase was not made, even though the stock markets have performed relatively well. But when interest rates are substantially lower, it impacts our future obligations and commitment to you, our members, to provide lifetime annuity income. Also, the basic and participating annuity monthly payments already incorporate a 4% annual growth assumption that continues to be built into the calculation of your lifetime annuity. For these reasons, the Board of Trustees decided this year that an increase could not be made. Be assured the pension board's basic and participating annuities are favorably positioned to continue robust payments to you. Compared to most corporate and state pension plans, our disciplined and sophisticated management of the annuities has resulted in a very healthy funded status. Please now watch our fireside chat to understand how the pension boards arrives at this very important decision each year. Thank you for your continued trust in us.
Hi, I'm Jim Mose, Executive Director of Faith and Finance Ministries at the Pension Boards of the United Church of Christ. Friends, if you are a pension board's annuity plan member receiving lifetime annuity income from either the basic annuity or the participating annuity, then you know that during the fall of every year, the pension boards arrives at a decision that determines your monthly income payments for the next year. But have you ever wondered how the pension boards arrives at this decision? Well, here with me today is Brian Bodiger, President and CEO of the pension boards, to help us understand this process. Welcome, Brian. Brian, can you walk us through how the pension boards determines annuity changes each year?
Yes, Jim. In order to ensure that we have the necessary funds to fulfill our commitment of guaranteed lifetime income, we must look at what we call the funded status. And I can get into that shortly. Every November during the Board of Trustees meetings, our Benefits Committee and our investment team reviews the basic and participating annuity payments based upon the funded status and annual investment performance measured from September to September. During this time, the pension boards reviews the value in current dollars of all of its projected future payment obligations to all participants. At that point, a decision is made to determine whether monthly payments will increase, decrease, or remain the same effective January 1st of the following year. The pension boards then sends each member a letter informing them about the trustee's decision concerning their monthly income payment for the following year. Members' annuity payments may increase, decrease, or not change at all. It is partly due to our funded status.
Brian, can you please explain the meaning of funded status?
Yes, Jim. the end of September, we examined the funded status of the basic and participating annuity investment pool of all of our annuitants. The funded status is the relationship or the ratio among three things. First, the financial assets of the pension boards. Second, the market value of those assets in each annuity. And third, the present value of all the pension board's future monthly income payment obligations to members participating in the basic or participating annuity. For example, if the pension board knows that it has to pay out Reverend John and all others in our investment pool $50 million over the next 20 years, a healthy funded status simply means that the pension board has the necessary assets available to make these future payment obligations to Reverend John and all others who are annuitants. The funded status determines the pension board's decision to offer a monthly payment increase, decrease, or to leave the annuity payment unchanged from the previous year while remaining well-funded. So in order to ensure monthly payment obligations to our members for their lifetime, we must look to the funded status of the basic and participating annuity investment pool. Let's dig in a little deeper, Jim. If our funded status is below 95%, the monthly annuity payment may decrease for that year. If the range is between 95% and 110%, payments may remain unchanged. And if our ability to meet future payment obligations is well above 110%, then the pension boards may offer an annuity increase. I want to assure our members that the pension board's disciplined and sophisticated management of the annuities by both staff and consultants has resulted in a very healthy funded status when compared to most corporate and state pension plans.
Thank you, Brian, for pointing that out and for explaining the term funded status. Now, there's also a 4% annual growth assumption that's built into the annuities. Can you please explain what that means?
Yes, that's true, Jim. Both the basic and participating annuity monthly payments already incorporate a 4% annual return assumption that continues to be built into the calculation of the member's initial and ongoing monthly income payment. If an annuity adjustment is made based on our funded status, either higher or lower, those adjustments already incorporate a 4% annual return. Let's take a look at this scenario. Say a member decides to annuitize account holdings of $100,000. And for this example, the member has a 20-year life expectancy. The investment pool from which the member has the account includes a 4% annual growth assumption in a calculation that considers the member's life expectancy. This means that the pension board expects the $100,000 to grow at 4% a year for each of the 20 years, or a total of $145,000. The member's monthly payment will then be approximately $604 a month, unless there is an annuity adjustment made along the way. Now remember, we discussed funded status as being above or below a certain level. Before the pension board makes any adjustments to increase or decrease a member's annuity payment, our funded status will have to grow either beyond the upper limit or fall below the lower limit. Now, using a similar scenario, let's say the pension board has reached a 114% funded status, which is well above the 110% range. In this instance, we may decide to offer a 2% annuity increase for all annuitants in the investment pool of the basic and participating annuities. The member already has the 4% annual growth assumption calculated in the annuity, plus the new 2% increase to their monthly payment. In this example, the member's new monthly annuity payment is now approximately $616, an increase of 2% or approximately $12.
That makes sense, Brian. And thank you for explaining to our viewers how annuity changes are determined by the pension boards. We hope that you, as our members, now understand the process a bit better. Be assured that the pension board's basic and participating annuities are favorably positioned to continue robust payments to you for your lifetime. If you have any questions or concerns, our dedicated pension counselors are ready to assist you and provide individualized consultation sessions. And before you make any investment decision, we encourage you to consult with your financial advisor or an Ernst & Young planner. Remember, EY Financial Planning Services are a no-cost benefit to annuity plan members. Thank you, God bless, and be well.